broader part of the population do not have an interest to equip themselves with the right knowledge. They tend to tilt towards something that is like a, get rich quick scheme, or either something that a program that is too fast, too much like a shortcut to really equip yourself to deal with all these movements in the market.
Hello, my name is Andrew and welcome to another Chill with TFC episode. In this series, we talk to interesting people with relevant experience and insights to help us learn from their perspectives so that we can create the life we love and manage our finances well. My guest today is an Associate Director on the Discretionary Portfolio Management team at CGS-CIMB Securities. His job includes managing discretionary investment mandates for the team. And that includes conducting quantitative research to uncover new sources of alpha. We love that word, alpha. And also to build proprietary, strategic, and tactical asset allocation models, multi-factor equity strategies, and mutual fund selection models. All these means he's a quant, he's a numbers person, smart guy, and he has unique insights based on his way of thinking and looking at things. Let's welcome Jake. So we want to talk about thematic investing. You have your own take on it. Now, maybe you run through with me some of the points that you want to bring across in this conversation.
Yeah. Okay, broadly speaking, my own definition of thematic investing, it's anything that falls out of the call allocation, meaning they are typically sector specific. Let's say things like technology, things like industrials, things like materials, or rather in the most recent event that we are witnessing right now, you can see the financials are moving up, or at least the financials are experiencing a net inflow of capital because compared to the technology sector. In fact, technology funds has always been doing very well historically. One of the largest alpha provider. The only thing is because like all sector or most of the thematic funds, they are cyclical, depending on a lot of macroeconomic events to drive the underlying rotation from the global asset managers.
Technology as a theme, although some of us might be so familiar with it that we might not think of it as thematic investing anymore.
That's right. That's why I think it's very important to lay down my definition of thematic investing, but of course it can go narrower into things like EV, things like solar, things like green energy. Yeah, it can be very narrow.
In fact, there's so many themes nowadays. Anything you can think of, there's a theme for it, right?
Precisely.
E-commerce as a theme, or meme stocks as a theme.
That's right. Those are very, very short term, especially if it's not backed by fundamentals, right? In fact, they tend to mean revert far faster than most people can anticipate. So I would say if you think that you want to get that kind of exposure, if you're savvy enough, you can take the risk enough, why not, right? But the key thing is about managing your exposure. For most of the investors out there, the hardest thing to do is when you have zero exposure and you see that thing move up, right? So determining how much exposure to have, I think that's the most crucial thing. Never think of like putting all in or giving, let's say going all in, simply because that you think the gains are good. Because when it flip or when it roll over, you couldn't be fast enough or couldn't be decisive enough to know how much to get out, how much losses to take to get out, or how much gains or leftover gains that you can take while getting out.
So would you agree that when people choose thematic investing, well, it's to beat the index, right? If not, why else would you do that?
Correct. It is definitely possible. But of course, the key thing is you need to know how much of it you're dedicating or allocating to the so-called the tactical exposure. Is it going to be 20% of your entire portfolio? Is it going to be 30%, or is it going to be 70%? Right. Of course, if you can time it right, your gains are definitely going to likely beat the market, right? But the biggest question is, because investing is a long haul game, how frequent and how consistent can you be? The broader part of the population do not have an interest to equip themselves with the right knowledge. They tend to tilt towards something that is like a, get rich quick scheme, or either something that a program that is too fast, too much like a shortcut to really equip yourself to deal with all these movements in the market.
Okay, so what do you think is hype, and what do you think has more value that we should be looking at in the long term?
Okay, that's...
Well, in vogue, right? Talking about in vogue, right? Metaverse is in vogue. There's a
correct.
Metaverse theme that I saw recently.
Agree. A lot of people who are in IT or in those very advanced IT guys, they can't even put a finger to what's Metaverse, right? Of course, we can only find ourselves along the way while we develop all this technology. And of course, right now the ecosystem it's diverse, right? Nobody can really pinpoint what's going to happen. I can only say, yes, the future is always driven by changes in technology. We do not know what's going to happen, and having the right exposure, right, be it 5 to 10% of our portfolio in names that develop Metaverse or they're in the Metaverse ecosystem, I think it's a good bet to have zero bet. Right, but then again, Metaverse still goes back to either the technology sector or the communication services sector. So even if you say, I don't want to be so narrow, I want to bet on communication services, which is some of your names, your familiar names like Facebook, Google, right? They are by virtue having some exposure to Metaverse, but they are in a broader sector. So to have exposure to these names, it's a proxy for being part of Metaverse as well.
Right, I mean, there's also hardware.
Yeah, correct.
And there's so many things that you can... And the Metaverse, well, it depends on how you look at it. It's not even... you don't see it yet.
Correct.
In the near future, at least.
Yeah. A lot of people can't even describe it properly. Right? So, as of now, strictly speaking, I would say it's a hype until we can see, something more tangible developing.
So your personal style is that you would take a step back and then you would see something... You look at the fundamentals before you invest in themes.
For the tactical part, that means on the trading part, I will make a bet if I feel comfortable about it.
Okay, you allocate a bit to the bet.
Right.
Yeah,
correct. It doesn't need to have any fundamentals. For the investment side, it needs to be backed by fundamentals. Okay, I don't want to say I can do better than some of the guys out there, but those guys out there who can outperform the market are usually the ones who pay very close attention to how the technicals are playing out, because the technicals are basically, like I said, the net flows of money, right, changing hands, and where is it likely to go. If you want to beat the market, you've got to pay attention to where this flows are going, and this is what the academic factor called momentum, right? Of course, a lot of people that I spoke to, a lot of people that I engage with, they tend to like or love value investing more. I cannot explain why, but in my own work and my own research, given the intimate knowledge that I've developed over the years, value investing, if it works, right? Because ultimately it's a factor. The only question is how do you implement those factors?
When you mention factor, I understand that's a very technical and specific term that you're using, right? Could you explain it for me?
That's right. Because actually factor investing is nothing new. It's what we are very commonly used to, like value investing, trading, like trend following. Trend following is very similar to momentum, right? And if you look at momentum, of course, you can go into the more specifics like absolute and relative momentum, right? I don't want to bore you with that, but essentially it's where the market is heading, or where the let's say the instruments or the sectors are heading. And broadly speaking, if we are investing for the long term, the asset class such as equities, especially global equities, right, without tilting to a specific country, it's a net positive regression. That means your long-term net aggregate returns, you're looking at 7 to 8% annualized, right? But of course, if you have a certain tilt, or you have a specific strong exposure to a country like, for example, US that has been outperforming the rest of the world, yes, you will do better if your portfolio is concentrated with US exposure.
Okay, so the tilt is what helps you beat the market or underperform it?
Beat the market.
Beat the market,
correct.
Okay.
Either by performing better than the market or beating the market, because beating the market, very few guys can do it consistently. You can beat the market, so-called beat the market, over the last 2 to 3 years. But yes, correct. The consistency is something that a lot of people cannot claim to have. One of the key things to make money consistently, beat the market, it's to follow the momentum factor, right? Even when I can show you a lot of track record of how these factors has been performing. Momentum has always been the best performing, right? But it suffers a lot from the momentum reversal from time to time. So it's not easy to implement because you need to know when to get in and out and when to pull back on allocating to momentum. Yeah.
And there's also the difference between retail investors versus institutions, right?
That's right.
Yeah.
That's right. For a lot of funds, whether they claim to be fundamentally driven or non-fundamentally driven, in order to beat the market, you need to have exposure to the momentum factor, whether it's intentional or unintentional. Otherwise, you cannot beat the market.
Right. If you consistently can beat it, then you're the god of investing or something.
That's right. Yeah. So, but then again, because the cultural thing, it's very deeply entrenched in the investment community, because people still love to hear from the investors or the asset managers that, hey, I'm a value investor, or I'm very fundamentally driven. Yeah, because the minute you bring out something that says we're using technicals, we're using this and that, using RSI, they tend to shun away from this kind of strategies, right? But then again, they'll be attracted to the strategies if it's being presented in a different narrative.
How should I look at the fundamentals in this case?
If you ask me, a value investor or fundamentally driven fund that can beat the market, it's doing two things. First, it is implementing the value factor correctly. Second thing is they manage to blend the momentum factor into their investment strategy, right? So there are many guys who can do that, except that because in the investment universe format, right? For mutual funds to do that, they can, but usually they will restrict capacity, and therefore they are not your usual high-profile funds out there, right? Without going into specific names, there are a lot of guys out there who can do relatively well, but it's just not so well known. Yeah, because due to a lack of marketing, or they simply is happy with the kind of capital they manage.
So if I were to get started into thematic investing, do you think I should pick a theme that I'm interested about, I have a competence in, I have knowledge about it? Like, how should I start? What should I take note of in thematic investing?
All hobbies, right? We should really be passionate about. We should really spend a lot of time reading up. In fact, there is a lot of literature out there by these data providers or by a lot of free and public portals like investing.com, Wikipedia. I think that's Investopedia. Yeah, correct. By spending a lot of time even in these free domains, I think you will pick up a lot of knowledge.
For you, what are the top 3 themes you're looking at?
I would say electric vehicle, correct, because it's very tangible. It's something that you can track very closely. Artificial intelligence. It affects a lot of our day-to-day lives, like a lot of algorithms that are behind all these websites that we are using on a day-to-day basis. What kind of spending patterns, right? I would say it has to do with how technology advances and how we use algorithms. Yeah, of course, AI, in the AI space, like the ESG team we talk about, there are a lot of guys who claim that we are AI competent, we are AI capable, but a lot of the AI is actually not AI. It's just very simple, basic machine learning. Not so much into the neural networks, correct. There are some guys doing a lot of work, especially in the investment world right now, but they still can't find a very good way of applying neural networks, because it's simply not easy, because of the very simple fact that the markets are very unstructured, right? Neural networks is good at doing unstructured environment.
Could you give us an example of a company doing AI and deep learning and building all these neural networks?
I would say Google.
Google.
Google. Yeah,
Okay.
correct. Google and IBM.
Okay, so
Yeah.
your AI play will consist of all these companies.
Correct. Yeah. In fact, without going into specific like AI, Google is the leader in terms of technology, and that's also one of the reasons why um, it's leading in a lot of the broad market indices. Yeah,
Okay.
correct.
So EVs, AIs, is there another one that you're looking at? If I were to ask for a top three? If not, we can focus on this too.
I would say technology is ultimately what shapes our world, because it will filter down into other sectors or industries as well. Because in order for healthcare to come up with new technology, I believe right now the broader technology is nanotechnology. That means you're going into very small components, because when we look at the whole evolution of technology, first we have steam engine, followed by electricity, and third is computing. And right now we're in the fourth stage of the the technological evolution, nanotechnology. So everything becomes small, embedded, wearable, and you have a lot of chips processing all the kind of information you can ever pass to a very small computer. Correct. So all these things are eventually shaping how the rest of the market will develop, all because of the speed of the speed of the computing power that we have right now, and plus the ability to do multiple iterations at the kind of speed that we can never imagine 20 years back. Yeah.
So nanotech, healthcare, EVs, AIs, they fall under the technology umbrella.
That's right.
How do you screen for opportunities in this space?
I'm a little bit lucky because I have professional platforms to take advantage of. But I would say, going back to the technology advancement that we have right now, in fact, if you look at Yahoo Finance, many years back, I still remember I used Yahoo Finance. We don't even have data for the S&P 500 going all the way back to 1929. Oh, sorry, 1927. Yeah, in fact, that's the data I can use on Bloomberg right now. I can't go beyond 1927. Yeah, so Yahoo is giving you this kind of data. More and more free domains are giving you free information that you can take advantage of. You don't need, well, if you ask me, you don't really need professional level kind of data to make proper analysis.
Yeah, because they're free platforms.
Correct.
And even for the paid ones, it's probably, it could be affordable. And so it'd be helpful to talk about, what are the factors you look at for your own investments in terms of thematic investing.
Correct. For my own investing, I typically like to do my call and satellite allocation.
Okay.
Right? Call meaning I invest in very passively track ETF that track passive index like the STI index ETF or the SPY index ETF. Right? One thing I like to point out is there's not much point to try to beat the S&P 500. Right, because most of the guys out there cannot beat.
Okay.
I tried it myself. Cannot.
Then why do themes, right? Okay.
Correct. Yes and no. Yes and no, because if you can time the market and you can time your thematic exposure better than the broad market, I would say yes.
Yeah.
Right. But if you try to beat the S&P consistently by focusing on certain thematic investing, it's very difficult to do that. Simply because the market in US is too efficient, and there are a lot of brain power out there, geniuses out there, tons of PhDs out there trying to create algorithms to beat each other. So no point trying to beat the US market. But for the less efficient markets, anything outside or anywhere outside of US, you have a higher chance of beating the market. It's very possible.
Okay. And what markets are there?
Developed markets outside of US.
Hong Kong.
Correct. Hong Kong, Europe. In fact, Chinese market is quite inefficient. Yeah.
Right now.
Correct. But of course that may change given the fact that they are opening their doors to institutional investors coming in. But then again, it will still take a good 10, 20 years for outsiders to catch up with how the market microstructure is changing. So I think we still have an advantage, or rather the retail investors will still have an advantage over the professional guys for the next 10, 20 years.
Okay, that's a good wake-up call. It's
Yeah.
probably relevant for myself when I first started investing, because there's always a part of you that thinks that, maybe I can beat the market, but it's kind of like, well, it's really difficult.
Correct.
After you've been in the market for a few years.
My advice to all the guys out there is, before you try to beat the market, you better make sure you have your beta exposure. That means the market exposure. Correct. Because if you have zero market exposure and you're trying to beat the market by allocating a high percentage of portfolio, if you cannot beat the market, and let's say you suffer heavy losses, and having no market exposure, you are looking at a very poor performance overall. Right. So the key thing is your core exposure or your core allocation should focus on having market exposure. Then your satellite or your tactical exposure focus on trying to time certain elements of that rotation going on in the marketplace.
So let's take myself for example.
Yep.
Let's say I want to get into thematic investing, and what I'm going to do is probably look at the available themes out there.
Yep.
So how do I evaluate the fund managers, and how do I evaluate all these different funds? Let's say I pick a certain theme that I'm more interested in, that I have knowledge about, and I go into it. How do I choose?
Generally, I would say there's two answers to your question. First would be, if we're talking about in ETFs passively tracking certain indices.
And that is the thing about tracking error.
Correct.
Right. It's a huge thing in themes, right? Especially for themes.
That's right. For certain thematic themes that you're looking at, let's say you're investing in a mutual fund that says you're getting exposure to EVs, right? Or it can be anything.
Right.
Actually, the best thing to do, right, is to make sure that the fund manager has got very high tracking error or tracking difference, because you don't want it to be behaving like an index, right?
Okay.
That's right.
That's the alpha.
That's right.
That's the alpha.
Correct.
Okay.
Yeah. So there's no point in having a very active fund manager having very low tracking error, but he's behaving like an index.
Then you might as well invest in the index.
That's right. It's how do you evaluate mutual funds effectively and objectively? Yeah, correct. It's a biggest question out there that's bothering a lot of investors, because it's very hard to compare apple to apple, because some of these funds, they have similar names, they have similar investment mandates. That is what they communicate to the public, but what they're doing is different. And so that's the reason why I choose to use all these financial ratios, or rather performance ratios. These are typically risk-adjusted ratios, because Sharpe ratio and Sortino ratios are risk-adjusted returns ratios. These two are very closely correlated. In fact, Sortino is a deviation from the Sharpe ratio, right? And Sharpe ratio was actually developed for measuring of mutual funds performance, right? So to keep it simple, it's basically to measure the risk-adjusted returns of the mutual funds. So for every additional unit of risk that this fund is carrying, how much more he can return to the investors, or rather potentially how much he can return to the investors. So Sortino ratio strips out certain element of the Sharpe ratio to measure the downside risk that it carries when this funds experience a drawdown. So it actually gives you a better picture of how the fund manager is dealing with a drawdown, or how he navigates the market during a drawdown. So the lesser the fund the lesser the fund manager experience a drawdown, it goes on to show that he is able to mitigate the fall of the investment much better than his peers, right? So these are some of the things that I look at, and information ratio is basically measuring its performance against its stated benchmark and also against its peers.
Right, because comparing against peers is important, right?
It is,
themes, you look at historical data, but you also need to compare all the different similar themes out in the market.
That's right, because in most of the market segments that these fund managers are investing in, there are usually 50 to 100 similar peers. So for anyone out there trying to pick an investment team, whether it's in a ETF or mutual fund format, I think one of the key things people have to pay attention is any strategy, any thematic or sector strategy will ultimately go through a period of drawdown. That means it will outperform for a few years and you will have what we call a mean reversion. But ultimately, we need to stay focused on some of the thematic exposure that it has long-term to be proven to be more robust than some of the average sectoral exposure that we can see. Some of these would be your technology. In fact, I myself try to construct portfolios that has got a higher relative exposure to technology and consumer discretionary and also healthcare. So these are the three broad themes that I always try to structure my portfolio around with. It's a matter of when I'm implementing the strategy, do I raise or decrease the weights within the portfolio? Yeah.
In these three areas.
In these three areas, broadly speaking. But of course, if let's say when the time calls for it, because the market is in a very specific environment, I may raise exposure to materials. Like for example, right now the material sector is very strong by virtue because and it's correlated with energy sector, right? So these two sectors are strong, but on a long-term perspective, energy sector has always been very volatile, and so is materials.
So this is where timing comes in.
Correct. So the timing element is also very crucial. But for the very, let's say, very lazy investor out there who simply say, I don't want to try timing it, but I want to have certain sector or thematic exposure within my portfolio, I would definitely go with the suggestion of having technology as a permanent strategic allocation, but maybe you can from time to time raise it or decrease it. Consumer discretionary and healthcare. Correct, because healthcare has a very defensive nature. Yeah.
And couple that with the technology nature, which is
it's aggressive growth.
Yeah,
correct.
you can have huge drawdowns at any one point in time.
Correct.
Yeah.
So it balances out all these headwinds in the market.
And consumer discretionary kind of sits in between.
That's right.
Yeah.
That's right.
All right. Yeah. Okay. Thank you, Jake.
No problem.
Thank you.
Thanks for having me.
Thank you for watching this video. If you found it useful, like, share, subscribe, and feel free to leave your comments. You can also join our Telegram group, follow us on social media, and sign up for our weekly newsletter. Everything is in the description. For more content, check out thefinancialcoconut.com.